Since you're here, you're most likely looking to begin your journey in day trading and do it the right way. I've been in trading for quite a while now, and I can tell you, if you start without a proper foundation, you can spend years fighting a losing battle, wasting money, and ending up more confused than when you began. But if you do everything right from the very beginning, you can build an excellent income-generating machine, and 2025 is the perfect time to get started. In this video, I'll cover everything a beginner needs to confidently start day trading. We will discuss the right mindset, the most important rules, how to analyze the market, and the tools that will help you stay organized and efficient. It's crucial to understand that even if you only have a small deposit, you can still start and grow, provided you follow the rules. By the end of this video, you'll be ready to take action. Think of it as a complete guide to starting day trading in 2025, with a clear step-by-step breakdown for anyone who needs a solid plan. If you enjoy trading and investing content, hit the like button and turn on notifications so you don't miss any new videos. Alright, that's it for the introduction. Let's move on to the most important factor that will determine your success in day trading. Critically important mindset. Let's start with mindset. Most beginners fail because of how they view money, risk, and discipline. Things that seem logical in everyday life, for example, having an emotional attitude towards expenses, often turn into pitfalls in trading. You've probably heard that 90% of people end up losing money. That's because most people don't know how to separate their emotions from the rules that must be followed. The good news is you can reprogram your mindset. Instead of perceiving money emotionally, day traders learn to think in terms of probabilities, statistics, and precise rule execution. That transition from emotions to statistics was my biggest breakthrough. If you understand this, you'll already be one step ahead of most beginners. Common misconceptions. You need nerves of steel. Actually not. At least not in the sense many people think. If you have clearly tested rules and a solid plan, you don't rely on luck. You rely on a system. Nervousness appears when you don't understand what you're doing, when you act on a whim. You have to be a genius. Extremely high intelligence can sometimes get in the way if the person is stubborn and doesn't want to change their views. Some of the best traders I've met were ordinary people who simply followed a structure, stayed organized, and maintained discipline. You need luck. Luck in trading can be both good and bad. The point is, if you repeatedly place yourself in the right conditions using a method with positive expected value, then over the long run, your results will be in your favor. What you really need: firm rules. Without specific instructions on when to enter a trade, when to exit, and how much to trade, you'll become a hostage to emotions. Organization. It's impossible to improve what you don't measure, so you must track every trade, record the results, and analyze them regularly. Execution. Once you have rules, you have to follow them without hesitation. That's why you need practice in real market conditions. When stress hits, you rely on your training, just like an athlete scoring a decisive point. If you handle these elements, you'll have a solid foundation to build upon. A simplified approach to trading. A three-step process. A lot of beginners immediately ask, which strategy should I choose? Which indicators should I look at? How do I set up the charts? All of that can be confusing, but I suggest viewing the process more simply. Over the years, I've realized you can break trading down into three stages. Observation. First, find something in the market that repeats on a regular basis. This might be a pattern, a timing correlation, or a particular signal you notice over and over on the charts. Formulating a hypothesis. From that observation, create a set of clear rules. For example, when a certain asset's price reaches level X and stays above or below that level for a few minutes, I open a trade with a specified expiration time. It's important to be precise so we can test these rules. Testing. You can use a DEMA account or small real amounts to check how your system works over dozens of trades. Pay attention to key indicators. How many times does the trade close in black, win, and how many times in red, loss. This will help you see the statistical strength of your strategy. The main thing is not to abandon an idea after just one or two trades. Gather a sufficient sample size, then decide, based on numbers, whether to continue or make adjustments. Using the right tools. To get into day trading, You need a platform where you can choose assets, currencies, cryptocurrencies, stocks, indices, and commodities, analyze price movement, including basic indicators and timeframes, control trade expirations, and payout percentages. Right there, you can view charts, open trades, and track your results. Also, use a spreadsheet or any other method, even notebook, to record every trade, entry time, trade amount, choose an asset, and outcome. The more detailed your journal is, the easier it will be to see where there's a room for improvement. All the important data for analysis is available in the trading profile. How to calculate risk. Let's say you have $1,000 in your account and you've decided you'll risk no more than 5% of your deposit on each trade. That means the trade amount would be $50. Suppose that at the moment you open a trade, the payout percentage is 92%. If your predicted price turns out to be correct at expiration, you earn $36, which is 92% of 50. If the prediction is wrong, you lose the $50 you invested in the trade. Thus, your risk on each trade is the entire sum you invest. It's $50 in this case. Potential profit is calculated as the trade amount multiplied by the payout. Why maintaining proportions is important. If you impulsively raise your stake from $50 to say $200, you're significantly increasing your risk as a percentage of your deposit and might lose money too quickly if you hit a streak of bad trades. By keeping a consistent risk level, for example 5% of your deposit per trade, you'll be able to gather more accurate statistics and understand how viable your strategy is. Continuous improvement, tracking and adapting. The last piece of the puzzle is the ongoing improvement. You can't just set rules and hope for the best. You need to regularly analyze your results. Use the data in your trading profile. Keep a trading journal. Record every trade, the asset, the amount, the expiration time, and the outcome. Analyze sequences of trades, wins, loses, which patterns work better, which ones work worse. Review everything regularly, weekly or monthly, to see if your plan is working. Is your performance meeting your expectations? The more data you collect, the better you can judge whether your strategy is profitable or unprofitable. This way, you won't overreact to every losing trade, but you'll focus on the bigger picture. How to start trading today? Let's summarize what a beginner needs to start day trading. Check your mindset. Remind yourself that each trade is just part of a bigger cycle. A single failure means nothing if your system is profitable over the long run. A simplified approach. Identify a pattern or a price movement correlation. Clearly define your entry and exit rules. Expiration time, initiation a trade only when certain signals appear. Start with a demo account or a very small amount to see how the rules work in practice. Gather at least 20-30 trades before drawing conclusions. Record everything. Without precise trade records, you can't see your real statistics. Take notes on your results in your journal and analyze them. Control your risk. Decide on the percentage of your deposit you're willing to risk on each trade. For example, 1 to 5%. Don't break this principle after a few wins or losses. Improve your strategy. If the results don't match what you're aiming for, adjust and refine your rules. Try to do this based on facts, not emotions. Typical beginner pitfalls. Emotional trading. Don't open trades out of boredom or excitement. Always stick to a logical plan. Over trading. Don't try to make as many trades as possible. Often quality is more important than quantity. Ignoring statistics. Even with a low win rate, you can still be profitable if everything is calculated properly. Conversely, a high win rate can still lead to losses if payouts are low or your risks are too high. Irresponsible management of the deposit. Remember the percentage of the deposit you risk per trade and don't go over that limit. Lack of a systematic approach. If you just shoot trades randomly, you won't understand what works and why. We covered mindset, workflow structure, risk management, trade analysis, and continuous improvement. The most important step is to stop just watching videos and start practicing. A summary of actions. Formulate a hypothesis, a simple pattern for entries and exits tied to clear rules. Test on demo. If your results are good, move on to real account with minimal amounts. Record the results. Keep track of how often trades are in the money and your total outcome. Analyze, do a weekly or monthly review, and adjust your strategy. This way, you'll gain real experience faster than those who spend years chasing a magic strategy. Once you're ready, scale up your trade amounts, but stick to risk management principles so you don't lose your deposit. If you found something useful in this video, hit the like button and subscribe to our channel so you won't miss new episodes about strategies, risk management, and trading psychology. Thank you for watching. I'm sure that with the right approach, you can build your own machine for earning in day trading. See you in the next videos.